Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. We're recording this roundtable on September the 15th on the heels of a pretty historic and tumultuous weekend on Wall Street, one that saw one of the street's oldest firms file for bankruptcy and another get taken over. So at the time of this taping, we're looking at a changed financial world. Now, there are probably as many ways to address the story as there are facets to it, and so we thought what would be most helpful to you, our viewer, is if we stayed with the big picture. What does it mean to the financial sector? What does the news mean to the market, as well as the overall economy? And our panelists are going to give you their assessments, starting with Steve Reitmeister. Steve is our editor-at-large at Zacks.com. Then we'll hear from Kevin Matris. Kevin's head of our Research Wizard division. And, of course, Tracy Reinick is back. Tracy will give her assessment. She follows value stocks for us at Zacks.com. So this is kind of new ground. I mean, there's really not a roadmap here for what we're seeing go on in this financial sector. So if I'm an investor and I'm sitting back listening to this news and trying to make sense of it, my first question is, what does this mean to me?
Two ways, not two, 100 ways to look at this. If you have investments in the financial space or thinking about making investments in the financial space, it's still very dicey. Here again, our belief in earnings estimates, when the earnings estimates start going down for whether that be an individual business or a sector, we kind of stay away from it. And so for all of our different services, we've pretty much stayed clear of the financial space because, here again, we keep seeing it rolling further and further downhill in terms of how bad things look. And here again, we see yet another, here again, as you said, historic set of events this past weekend. So in investing in this space, very dicey. We stayed away from it going forward. I'd be hard-pressed to say, oh, the water is safe yet. I'd want to see a little more information. From the more global perspective, obviously you see a sell-off in the rest of the markets because the financial system is what lubricates the overall economy, and obviously disruptions in the financial markets, that's what people are reacting to at this point.
Albeit, though, a disruption, yes, but albeit a pretty orderly sell down today, Kevin. I mean, the markets are pretty orderly.
Yeah, I was looking at the futures last night and this morning, and they were down almost as much as 400 points, but you did see the market open up. I mean, granted, it started ticking lower right from the opening bell, but it was very orderly. It was, kind of controlled. Nobody was out there panicking. The volume wasn't, the biggest volume we had ever seen. So that was kind of encouraging in a way. Granted, we're still 300 points lower at the time of this taping, but yeah, it was a bit orderly. But I'll tell you, it's interesting seeing Lehman take its lumps because it kind of answers the question of moral hazard. Financial institutions will be allowed to fail. There are consequences for taking on risk, and Lehman right now is paying the price in a big way. What I find very interesting, though, is that when the Fed orchestrated the bailout, if you will, of Bear Stearns, that was supposed to preclude the Lehman Brothers, the Merrill Lynches, from going through what they're going through right now. And here we are. What I think is even more interesting of all is that, if Lehman would have put themselves on the block or tried a little bit harder to be able to get themselves sold, they could have got close to $50 because 6 months ago that's where their stock was trading. Now, they're getting ready to go BK and their stock's at 20 cents. Merrill Lynch, they were over $50. Yeah. They got bought at a premium from Bank of America, $29, but they were trading over $50 6 months ago. So this is all very interesting, but
when you bring up the moral hazard issue, though, that was exactly one of the arguments I saw for letting happen what happened over the weekend. Because the argument was, well, if we were to bail these people out, this firm out, even though they were one of the oldest firms on the street, the question of moral hazard comes into play. Well, then, who's going to be accountable for bad decisions that are made in business? You buy that moral hazard argument, Tracy?
Well, sure, because now we're seeing problems with AIG. There's problems with a few of the other banks that are going to be coming down the road. And do they bail out all of them? They can't keep going on. And then you have the car companies that are coming forward saying we need some help here, and then will it be the airlines, and then some real estate companies maybe? So then where do you draw the line? And finally, the government had to say this weekend, we're drawing it here. Now, whether or not, this
you
will
agree
work.
with it is another issue, but
Right.
this is where we're going to draw the line in the sand here.
Right.
So does this mean that as far as the crisis is concerned, we may be just beginning to turn the corner?
Yeah, I would say that we are probably past the halfway point. That means there could very likely be other scary moments in the not-too-distant future. But what I like from this weekend, and by the way, I know a lot of people want to knock Bernanke and Paulson. I think overall they were handed a pretty tough hand, and I think they're dealing with it about as well as I can imagine. The creativity of what they've done since the beginning has been exceptional, and trying to go things orderly. And here again, and then saying this weekend, financial industry, heal thyself.
Right.
That there is some moral hazard, that some folks will be allowed to fail, and hey, somebody buy out Merrill because we don't want that mess on our hands. And so I like the way they're handling things, and I think that is good for nearing an end to the financial crisis. Nearing and is one of the things we talked about here. Once we get lower commodity prices, which we already have, that oil coming lower and the other things, so that takes away some of the inflationary scare. Now, if we can get past this financial crisis, then the economy starts to get back to its normal, healthy self.
So, Kevin, I think what I'm hearing is if the medicine doesn't taste bad, it's not good for you.
It's interesting. Let me think about that. We were talking about, is this the beginning of something brand new? And I think most people agree that we are closer to the end than the beginning. And hopefully that bears out. What's interesting, too, though, is that, you're looking at a lot of the financial talk shows and everything, and everybody's talking about the U.S. problem, the U.S. crisis, U.S. financial crisis, but it really is a global crisis, if you will, because you've got 10 of the largest banks and financial institutions. They have come together as a consortium of 10, and they have put together this big pool of money, $70 billion, to provide additional liquidity for banks and financial institutions if they need it. So you also have the discount window. Then you have these independent enterprises or businesses coming together to try to help themselves, if you will. So you can see that there is a lot of global concern about what this really means. As for what it means to the individual investor, though, there's a lot of ways to attack it. First off, if you want to avoid risk altogether, just stay away from every single financial company. If you want to figure out, what financial companies could be, benefactors from this, a lot of the regional banks have been doing pretty good. There's a lot of banks that do not have this kind of exposure that are going to be able to do well. You've seen a lot of regional banks do great since the July 15th lows were put in. There's a lot of smaller boutique investment houses that are going to be picking up a lot of business that are going to have to find new homes.
So does this all give new meaning to that old adage, Tracy, no risk, no reward?
To some extent. I don't totally agree that the regional banks, I see some benefits for them, but I do think they're going to have to really rein in the kind of loans that they're giving. There's still a lot of risk for them just in general out there in the financial, scene, and they're going to pull back. So for instance, someone who's running a small business and is going to need $1 million to put an addition on a factory, they may or may not be able to get that loan now, whereas 3-4 years ago, they would have gotten that quite easily. So you're going to see all of that being pulled in, and it's going to impact on the regional banks. So for me, as a value investor, I don't look at the financials at all right now. I would say, revisit it, 6 months from now or something. But for right now, there's a lot of other sectors that are more of a value play right now.
Okay.
Yeah, risk and reward. I think a lot of people misunderstand risk. It's about volatility. Okay, what is the range of outcomes that could come up? In terms of our investment philosophy, we don't believe that you have to swing for the fences. You got to look for distressed sectors, because for us, the likelihood of success is too low. So yes, sometimes you do that, you can guess the timing right, and you can make a big return. But a lot of times you end up with bigger and bigger losses. Right. Say the guy who got into the financial sector 3 months ago. Okay, it's not going to get worse. These are the largest institutions. No, when the odds start going against you, meaning when the earnings outlook starts going low, we get out. Right. That's the way it is. So here, for me, I'm basically like, you know what? I'm not even looking at stocks and financial sector. That's not I just rather not, and I'd rather play it safer in other sectors.
Right. As a matter of fact,
Best earnings outlook.
if you're really trying to look for a good place to be, you can say, well, what does Lehman Brothers going out of business have to do with Walmart? Or what does it have to do with a drug company? Or what does it have to do with Campbell Soup, for instance?
Well, direct connection between this and the unemployment numbers, that's for sure.
Right. Well, maybe people are going to be, having more soup instead of steak.
Yeah.
But I mean, there's a lot of sectors that have a pretty good deal of disconnection from what's happening. So there really is opportunities everywhere. I just think it's imperative that people really get a grip on the risk that they personally are assuming in their own portfolio. Take your little nibbles in these different areas as long as you're comfortable with the risk. But once you see a trade going against you, I think it's extremely important that you cut that off right away because you don't want it to ruin your portfolio.
All right, there you have it, the thoughts of our panel members at the roundtable on the latest news from Wall Street. With Steve, Kevin, and Tracy, I'm Terry Ruffalo.